What's up guys, welcome back to my channel. So today I'd like to introduce a stock that I think is cheap to buy right now. That is Simon Property Group, ticker symbol SPG. Simon Property Group is the largest commercial real estate operator in the US and the largest real estate listed company in North America. It is one of the constituent stock of S&P 500 index and has the largest commercial real estate REITs on sale in the world. The peak is a market cap of more than 70 billion, more than the other 4 of the top 5 retail real estate companies in the US combined. If you have ever shopped in the US, you must have been to Simon. In the shopping center industry, Simon Real Estate has owned a variety of shopping centers, including a total of 232 retail properties and leasable areas for more than 190 million square feet. Simon's real estate business mainly includes 106 regional malls, 69 premium outlets, and 14 metropolitan shopping centers, and 4 community and lifestyle centers. SPG is one of the REIT stock. REIT has been a kind of an investment that the owner has been purchased properties and pays regular dividend to its shareholders. According to the regulator, it requires REIT stock pays more than 90% of their cash flow to the stockholders. So that's why REITs also be considered one of the dividend investments. And SPG stock has been dropped more than 50% from the highest point around $150, and the current stock price is only around $70. So there are several reasons why SPG stock has suffered from the big drop. So first is because the countries is in lockdown in the second quarter and people would avoid go to the places that has a high traffic like shopping malls. And the second reason is because there's less traffic in the shopping malls and outlets. A lot of the tenants of SPG has been suffer from the risk of bankruptcy. We have seen several retailers fight bankruptcy protection during this period, such as Neiman Marcus, JCPenney, and Brooks Brothers. And also because the rising of e-commerce, as people tend to habit to purchase things online, they are less likely to go to local shopping malls or outlets to do the purchase as they done before. So because of these circumstances, that leads to the revenue decrease of SPG, and that's also why that comparing with other REIT stock like Realty Income stock, ticker symbol O, it has recovered from the market crash in March, but SPG hasn't recovered. Company-wide, there's also some potential risk. The first is the company has a large amount of long-term debt when comparing with their current cash on hand. So because of the specific nature of the real estate, company need to use margins to use long-term debt as their margins to do more acquisition or to invest in more real estate assets. But for some investors, it can be a potential risk since their cash available is far from the debt they are currently hold. The second internal risk is that SPG has been focused on the commercial real estate, specifically like they mainly focus on the shopping malls, outlets, and also some regional shopping centers in the US. So that when there's a period that people could not go to the physical stores, their revenue would be affected, especially they have announced that in this Thanksgiving they will stay closed, so they would definitely suffer from some revenue loss from this perspective. But still, I think there are several reasons that's also why I invested SPG stock. The first one is the current P/E ratio is only 12. When you compare with other REITs, the P/E ratio is relatively on the lower side. I think everything has two sides. So on the one hand, the stock may have a high risk, but on the other hand, you can get the stock at a much cheaper price when comparing with other REITs. And considering that in the current stock market, the stocks with P/E ratio at 12 is not that much, I think SPG is one of them. And the second, of course, is a large amount of dividend it has paid. Although the company has cut its dividend from $2 to $1 this year because they want to protect their liquidity, but still they currently still has more than 7% of dividend. As one of the methods of investing is to depend on the dividend income, I think the stock is also a pretty good one. And the third reason is I saw that the company has taken this opportunity to do some merger and acquisition as well as some transformations. For example, they have been partnered with Brookfield Properties to acquire JCPenney, and they have been partnered with other companies to save Brook Brothers when the company is filed bankruptcy. So I feel like in every crisis, while some smaller players might suffer, some big players can take the advantages and to acquire some great assets at a lower cost. So I think JCPenney and Brook Brothers may be two of them. And also I saw the news that Simon has been discussing with Amazon to have a cooperation that they can use some of the space in the malls, like space in JCPenney and Sears, to let Amazon use as their warehouse for faster delivery for the last mile. So I think this transformation, we can also see that Simon is trying to be creative with his physical space and to make most use of it. And last but not least, I think like physical shopping is hard to be 100% related by the online shopping. For example, if we go to the mall, we may not just go to purchase something. We also want to enjoy the experience, like the leisure time spent with families, like diner outside, and also like go to the cinema and just to spend some valuable time. And this experience cannot be replaced by online shopping. So that's why I also have the confidence of the stock recovery. Yeah, so my average purchase price of the SPG stock is around $68, and I would expect that the stock maybe more than doubled and increased to the price level 1 year ago around $150. So, but that would take some time, around 1 to 2 years. And as a long-term investment perspective, I think it's a good investment. So that's all some of my thoughts about SPG stock. Hope you guys find it helpful, and I will see you guys in my next one. Bye!